really a pleasure to be part of such eminent panel. And thank you very much to Kamal and PMS AIF World team for putting all this together. Uh, I have always said in past and will again say in the alternate investment space, as far as India goes, most important thing is to create awareness and build knowledge on the product and the strategies because alternate investments is actually a very large gamut of investment products. So category one, category two, category three, and another again under category three, there are multiple strategies which are there available in the market. So investors actually get confused how to go about understanding the product, how to go about understanding the strategy, where it will fit right in their portfolio, how can it add value. So so such kind of sessions actually help investors and also distributors to figure out where and how they can place such products into their investors' portfolio. Now, it's Saturday afternoon. First of all, I would like to thank all the joinees, the attendees who have taken out time and are here to hear us today on this panel. Uh, so, first of all, to start up with, I would like to say, as far as alternate investments are concerned, it's a very large category, and you are hearing it since morning about different kind of products and strategies which are there. What we are going to talk now is the category three alternate investment fund space, which is predominantly into listed equity space. Now, under listed equity space, these are globally called hedge funds. In India, more popular name is long short fund. Again, under long short, you have multiple different kind of products available and strategies available. Some would be under long short, more tilted towards generating debt plus kind of returns. There would be some which are generating, which the mandate is to deliver equity kind of returns with downside protection. Then there are some which are run on quant basis, some are run on fundamental basis. And now, as we are seeing, there are some which are also run on the AI. Artificial intelligence and machine learning is being used in managing the the investment strategies. So, looking all these things, taking all these things in perspective, today we have the eminent panel with us, which will throw the light on different kind of products. See, as far as global markets are concerned, hedge fund industry is a large industry there. In US itself, it is a $4 trillion industry. And if I compare it with India, today, if I say that all Cat 3 funds put together in the long short space, we would be around $2 to $3 billion. And also, I'm giving an aggressive number. So there is huge scope of creating awareness and building space for this product in the client's portfolio. So credit to that. It's a very interesting topic today. When Kamal called and told me that it is the topic which you would like to moderate, I was very happy because this is the need of the hour. Significance of long short investing in HNIs, ultra HNIs portfolio. So I don't think I could have got better than this panel which I have with me today. Such a diverse panel. Harsh, if I see, comes from a fundamental investing background. If I look at Nandik comes with the more quant side and the more index investing kind of strategies. And if I look at Raman, he comes with is a techie into the investment space and comes with the artificial intelligence and machine learning. Using that, he is managing the portfolio. So first of all, I would like to ask you guys that, what do you think is the value add of having this alternate investment strategy into HNI's portfolio, long short investment strategy? And so if I start with you, Harsh, there are so many investment products available in the market. There's mutual fund, equities, debt, so much, bonds. Why do an HNI actually need it in the portfolio?
For any investment, the primary objective is high absolute returns. Very simple, point blank. So if you invest in equities, you can expect very high returns in long term. In short term, there is volatility, there is drawdown. But the end goal for any investment, whether in real estate, debt, equities, long short, hedge funds, the end game is just to produce high absolute returns. And long short fits in right into that. They try to make high absolute returns for the investors, which are not linked to the market. As you mentioned, there are some debt plus strategies, there are some hybrid plus strategies, but the keyword here is plus. So if you can make, let's say 12, 13% for the investors on a pre-tax basis, I think that would be considered as high absolute. So the objective of any investment product, including long short, is to make high absolute returns. And I think to a certain extent, without being linked to the market, without taking market support, long short has fit right into that. So I think compared to let's say debt funds or debt instruments, long short funds have given about 400, 500 to 500 bips alpha over that, which is a very, very reasonable alpha over the last 3-4 years. So I think, Ajay, the simple answer is high absolute returns.
And what could be, so Harsh, what, I know that you would have a differentiated strategy than other two panelists. So what can an investor expect from investing in your fund? Like what kind of results, what is the mandate of the strategy which you manage?
We basically have two funds. Both are positioned on conservative for conservative investors. One is a fixed income plus kind of strategy, where we are trying to make about 12-13% returns on an absolute basis with minimal drawdown. So its behavior in terms of risk will be lower than, let's say, short term or medium term bond funds, but on a returns basis, it is significantly better. The second fund has slight equity. Here our pitch is very simple, that if the markets fall or the markets are weak, when I say markets, I'm referring to equity markets, then the fund will basically protect investors' capital and produce fixed income like returns. If the markets are going well, then it will have some sort of up capture. So it's a hybrid kind of a scheme, but on both risk and returns, it kind of stands out much ahead of conventional hybrid schemes, which are available in mutual funds. These are the two funds that we have. And so we are positioning our funds for the fixed income investors. The only thing that is different in our funds is that we try to optimize the taxation as well. So our funds are generally quite tax friendly in that sense.
This is also a very important point. Actually, we'll come back to this point after a few rounds of questions. So Nandik, if I can hear from you in your perspective, see, you have just moved to Avendus from ICICI. So you have seen actually the large AMCs, which also have mutual funds, and then the boutique firm. So all kind of products we have seen, so from private equity to a retail mutual fund. So why do you think there is a need of a particular product into the HNI portfolio, and what value can it add? And also, if you can talk about in a brief about like what your strategy, the way you manage money, an investor can expect from that.
No, so fully agree with Harsha. Just one addition which I want to make is these kind of products which we are running is not helpful for just ultra HNIs portfolio. It would be helpful even to a normal investor's portfolio as well. It's just that by regulatory constraints, the entry point is a bit higher, that a lot of investors excluded. But it's not that the risk return profile would not be suitable to a normal investor. So what we do is we also have broadly two kinds of funds. The first kind of fund, we are competing with the debt segment. That's a flagship fund for Avendus. We call it the Avendus Long Short Fund, in which we say that irrespective of whatever debt does, irrespective of whatever equity does, we should be able to give you somewhere around that 7% plus kind of a number post fee and taxes. So which will translate to somewhere around that 13-14% kind of a number. Now, we are competing with debt segment, that particular fund. So what we are saying is you should not see a negative quarter. You should not see negative months also, but there is a low chance that possibly in a 12-month window, you see a small negative month. So that negative month could be one month in, let's say, a 12-15 months window, which let's say the fund is down 20-30. So the risk is comparable to debt. Possibly you say slightly higher, but the returns are much superior. So that is the first segment in which we compete in. And if you see lots of investors, would be very happy with that risk return profile, because for the moment interest rates are higher. But if you look at, let's say, fixed deposits, they would be somewhere in that 7 to 8% range. On top of that, you have taxation. On top of that, you have to lock in money, let's say, for 3-4 years or whatever time frame you decide on. In our case, I think in all the panelist funds, the liquidity which they have in the shorter, fixed income kind of category is much better. So you can take money out every month. So that also additionally gives investors that benefit, that you don't have to lock in capital for, let's say, 2, 3, 4 years. The other segment that we compete in, and where I think significant value could be added on. So this debt plus kind of a segment, I think many of the players have been there for the last 2 or 3 years. The other kind of a segment which I personally think could become really big is the equity plus kind of a segment. Now, if you look at how the flows are happening, the ETF segment is gathering in a good amount of AUM. And why? Because the investors are saying, I don't want alpha over Nifty. I'm happy, if you're able to give me just Nifty plus kind of returns, and whatever dividend returns comes, the fee is lower. So possibly I'm happy with that. So in that particular segment, what we are saying is, for example, the other bucket of funds that we have, let's say we keep 70 or 80% in stocks. And then using the remaining 20 or 30%, we take position in derivatives, preferably index derivatives, because that is what our forte is. And then over a 1 or 2 year period, we try and generate, let's say, somewhere around the 1.5-2% plus kind of an alpha over Nifty, post-fee, post-tax. So these are the broad 2 buckets under which we compete. I have come from a fund which is predominantly in the mutual fund side. So I can tell you that, if someone is able to generate these kind of returns, then the AUM will grow very fast. So I can tell you, in my previous company, there's a fund called the Balanced Advantage Fund. It is a 50,000 crore fund.
Yeah.
And there are competitors who are having comparable size. So that segment, for example, alone is 2 lakh crores. So, the scope is huge. The canvas is entirely yours. Like Harsha said, higher returns is welcome. The other thing is diversification is also important. So, for example, let's say you have normal equity investors, or let's say you have HNIs who have invested in equity funds. For them, if you're saying that, let's say 70% of the fund is kind of indexed to Nifty, and then using remaining 30, you take positions in derivatives. So that also is a welcome feature which would appeal to them. Now, one aspect is increasing returns. Second aspect is returns remaining same, but the risk goes down. So even that would be palatable to investors. So there are 2 parameters that investors are looking out for. The first is returns. But let's say if someone for the same amount of return generation is able to take lower risk. And what is lower risk? Lower risk could be lower standard deviation in daily returns. Or let's say if you measure risk by the drawdowns which portfolio has. So let's say equity market, when it goes up by 20% over 3 years, or let's say 15% CAGR over 3 years, if let's say it gives a 15% pain, peak to trough in the interim, if you are able to match the same returns, but let's say give only a 5% pain in the interim, even that is welcome. So I think the entire canvas is free. The focus can be on return enhancement at same risk levels. The focus can also be risk reduction for same or comparable return generation. So as of now, to summarize, at Avendus, we are focusing in the debt side on generating alpha over fixed income funds. And if you are able to generate somewhere around that 7% post-fee, post-tax, it's a good outcome. And in the equity plus kind of a scheme, we are doing a combination of stocks and options, index derivatives. And over there, we think we should be able to generate somewhere around 1.5-2% plus over Nifty, post-fee, post-tax at lower risk levels.
Now, that's wonderful. In fact, one thing which I can figure out by this conversation is, and what Harsh also said, is that, risk is a very, very important parameter when you both spoke about. So I also, whenever speak with the wealth advisors, I always tell them, when you design your portfolio, your job is to figure out which asset class should be there in the investor's portfolio and in what proportionate. So imagine if there is debt, if there is equity, both extremes, if you fit such kind of risk-adjusted strategy in your portfolio, which will reduce the overall weighted average risk of the portfolio and can actually enhance the return possibility. So globally, actually investors are treating long short hedge fund as a separate asset class altogether. Everyone has that in their portfolios. In India, still investors have to learn and understand that. So thank you very much, Anvik. So Raman, from you, I would like to ask questions in a little different fashion, because the way you manage money is very different. So can you, in your opinion, can you tell us what do you think the alternates can do to solve real problems, real life problems currently for the investors? And also, I would like to understand from you, what is the role of artificial intelligence in portfolio management?
So, Ajay, I think some of what the the other two panelists said addresses your first part of the question. I would probably present it from a more investor perspective. What are the real problems they are facing and how to help them solve it, right? In my opinion, alternative investments in India today help you solve two very specific problems. What are those? Problem one, with fixed income instruments, whether through mutual funds, through bonds, through treasury or other ways, MLDs, etc., with the taxation that's in place today, are they able to beat inflation by a comfortable margin? That's problem number one. And the answer is probably not, right? Based on which instrument you lock, at what rate and what taxation, you're probably talking of today a 4.5 to 5.5% kind of post-tax, post-expense return, right? Now that's obviously not enough. So to some extent, think of alternative investments, especially the format that they are available in India, consisting of a core of investment. That core could be either some kind of a fixed income portfolio or equity, okay? And on top of that, using that core holding as a collateral, creating additional income, mostly through derivatives. That's the basic idea where most of the alternative funds exist today, right? So therefore, if the core holding happens to be one or more of those fixed income instruments, you're already locking that fixed instrument return. And on top of that, if you could generate a 2, 3, 4% post-tax, that's sort of more than what any of those fixed incomes is going to give you, and therefore give you that buffer that you need to comfortably beat the inflation post-tax. So if fixed income gives you 4.5 to 5.5 post-tax, alternative investments can hopefully, the well-managed ones can give you anywhere from 6.5, 7.5 to the better ones actually even giving 8.5 to 9% in some cases, right? This is when the core happens to be the fixed income core. And on top of that, you generate the derivative income. So that's specifically one very concrete problem that investors have, that, and therefore my strong recommendation to investors is don't look at alternative investment funds, that what some others are referring to as debt plus, etc., as a tactical opportunity. I've heard a lot of investors think of it as, oh, temporarily, this is a great opportunity because nowhere else we are getting money made in fixed income. So let's park some money here until things look better elsewhere. I think given the large difference between what these guys are able to do on top of the fixed income, it is, in my opinion now, based on the taxation, etc., now, a permanent fixture in your portfolio, right? If you look at the global trends, you refer to the $4 to $4.5 trillion of hedge funds, right? Of that, almost 52%, right, which is more than $2.25 trillion is actually long short funds globally. Okay, so that's a large number. If long shorts globally were a country, it would be the 8th largest country by GDP. Okay. So that just tells you the potential of long shorts and alternative investment funds globally. In India, it's still a very small number, right? The entire AIF industry in India is probably what, 330,000 crores, right? Of which you mentioned the long short today is probably a couple of $1 billion or a little more. Actually, I think it's a little less than that. So it's very small compared to what potentially it can be. Now that's sort of just one problem that it solves. The other problem that, in my opinion, it solves, again, the other two panelists referred to the equity plus theme of it, which is, if you look at the trend in the last few years, right, unlike in the past, where most fund managers, especially in the large cap category, were more or less able to beat the benchmark, Nifty, Sensex, etc. In the last few years, most fund managers have struggled to beat Nifty, right? That to some extent, that's the idiosyncratic movement of some heavyweights, but also very increased efficiency of the markets and making it harder and harder for fund managers to actually generate alpha And I think one of the panelists referred to, therefore, the popularity of ETF, which is very logical, right? If as a fund management industry, you're not able to create alpha, why should investors give you any money for a fee? And I think moving forward, this trend is not going to reverse easily. Okay, if you look at US or how other global mature markets have played out, beating benchmarks consistently is not going to be easy, especially in the larger cap space, right? Where there's increasing efficiency. And I think there again, think of the same theme. You park your core funds logged into an ETF. So you log those returns more or less, and then use derivatives to generate alpha on top of that. That, if at all, there is a way to beat equity returns through benchmark would be one. So in summary, there are two problems you probably able to solve. One, you're able to do better than any fixed income if done right, and you're probably able to do better than equity benchmarks if done right. Those are the two problems, in my opinion, which can be solved.
So it's one thing which you said was very, very rightly said, that investors should not treat this investment opportunity as a tactical allocation in their portfolios. This is something which should be the strategic part of their portfolio. These are all cycle products, So like, for example, the product we run at ITI Long Short Equity Fund, it is more equity oriented fund. I always tell the investors, don't look at the product with the short term view. Never get into such strategies with a tactical mindset. Have a long term view. Give investment at least one or two cycles of equity market going up 20% and coming down by 20%. Then only you will be able to understand the value add of downside protection, what value it can add to the overall return of the portfolio. So this is very correctly said, that the strategy should be there with the long term perspective. Now, the other thing which I would like to understand is that there is a lot of discussion which is happening on quant versus fundamental. Okay, so now Nandik, if I ask you, what would be your view and opinion on that? Is it that do you think going forward quant is the strategy which is going to actually take away all the fundamental fund managers and make them free, and not keep them busy, because everything will be managed in a quant style? Or there is a room for fundamental long short investing also?
No, it's a very interesting question. I think money will come to fund managers who are able to generate alpha. So it doesn't matter whether you are doing quant or whether you're doing fundamental. Investors will see whether the fund manager or the company is able to generate alpha. If it is through fundamental investing, they are happy. If it is through quant investing, they are happy. The reason why, for example, quant investing has picked up recently is, like one of the panelists was mentioning, it has got very difficult to generate alpha over, let's say, in the large cap category. Possibly the reason why ETFs are gathering some kind of momentum. So, and that is the reason why some people thought maybe if we streamline processes, if we define the rules, then maybe if not return generation, at least it will be easier to explain as to what we are doing. So there are two aspects of investor, let's say, psyche. First is, of course, returns. Second is risk. And around risk, if let's say the returns are not in line with, let's say, what the returns were promised, then sometimes questions get raised as to why the promised returns are not happening, or let's say why the fund is underperforming. Then at least if you have a quant framework, you're able to justify your decisions. If it's more fundamental, then how do you go back in time and explain what happened then and there? I think it becomes a bit tougher that way. But in the last 100-200 years, of course, it's been fundamental investing which has driven the market. So there is scope and there is room for both of them. But I think investors will be less finicky about who is doing quant or who is doing fundamental. It will be purely a function of who is able to generate returns. That's it.
Harsh, I want your view on this. So do fundamental fund, you are on mute. So do fundamental fund managers actually have a chance to keep working in the era where a lot of things are moving towards quant? You are on mute, Harsh. You'll have to unmute yourself.
Sorry about that. So yeah, I mean, I have a very different view on this. So I actually don't agree that you can't beat indices if you're managing a large cap fund. I think that is completely untrue. Yeah, however, the data is showing that many fund managers in the large cap space have not been able to beat index. That is true. Globally also, that's been the trend. Having said that, I approach the markets with a lot of fundamental perspective, and I primarily do stocks. I mean, I don't do indices. So I buy but a certain basket of stocks and I short a certain basket of stocks, which is to make alpha. And my long basket, we also gave out the report as to how our long basket has done relative to Nifty. And in derivatives, we are talking about the top 200 stocks. So we have been generating alpha over Nifty purely from our large cap portfolio very, very consistently, not just on a yearly basis, but pretty much almost every month. So firstly, I don't think this thinking that fundamentals cannot beat indices. I think it's completely untrue. In India, many of the fund managers in the large cap space have not been able to beat Nifty because of very, very different reasons. When you look at large caps, I think 30% of the exposure is global. And if I look at global macros, you should be able to get your stocks right. So the fund managers who are not looking at global macros, they probably, will suffer or they will not be able to beat indices. But I think people who have a more comprehensive approach of looking at global fundamentals as well as, local, you should be able to beat indices quite comfortably. The second thing, which is very, very different and which actually, built the whole, term of thinking that I have for long short was my first training at Deutsche Bank. Deutsche Bank's prop trading desk, where I worked as an analyst for 10 years, is basically a quant fund. And they hired me to, send out fundamental signals to them. And they were trying to converge fundamentals with quants and try to see whether a blended approach works better or whether fundamentals in isolation work. And we found very interesting results. We figured that while fundamentals are working, quants were also working. A combination worked extremely well across markets, and we were tremendously surprised that fundamentals signals were working very, very strongly in India markets, and so were the quants. But when you combine the two, create a fusion out of the two, and then apply it to the markets, your returns were absolutely amazing. They were better than both fundamentals and quants individually. So I know for sure that if you create a blend or fusion of the two strategies, your returns or outcomes will be far, far superior versus individually versus fundamentals or versus quants. I'm quite sure about that. It's just so that I am not from a quants background, but having worked for the quants fund, in my subconscious mind tends to look at the stocks, the markets, probably what a quant model looks like or what he would read like. And intuitively, I tend to look at the market or the stocks from these quant, lenses while I'm looking at these stocks from fundamental perspective. So my stock choices are kind of, fusing in both the approaches. And we are again working in our fund also to have a separate quants team. We have taken some small steps towards that. And I'm sure that over the next 1 year, when we create that fusion of fundamentals versus quants, it will absolutely create a magic. Having said that, there is definitely alpha fight as more quant funds and better fund managers come. There'll be a fight for alpha. So the alpha should decay for everyone, but it's not just fundamentals who are going to see the deterioration in alpha. The quant funds are also going to compete amongst themselves, and therefore they themselves will see a decay in alpha. So I think the risk of alpha generation is far higher in quants than in fundamentals, personally.
Yeah, in fact, we are in process of launching an offshore fund via GIFT IFSC. So because of this, I am interacting with multiple global investors now, offshore investors. I realize that understanding of these strategies is like very, very much clear in the mind of those investors. So sometimes when I tell them, okay, long short, so they treat long short as a separate strategy, absolute return as a separate strategy. They don't call debt debt plus long short funds as long short funds. They say no, fundamental long short equity oriented funds are long short funds. These are absolute return funds. So that kind of understanding and proper bifurcation, maybe slowly in a full cycle, in the time and as the track record of funds gets built, Indian investors will also realize that what is the differentiation. Raman, I wanted to ask one question from you. So if I say that quant and AI. So like quant becomes a superset for that, correct? And like all AI strategies will be falling under quant. Am I correct in saying that?
Actually, it's a little bit like the elephant being probed by people who are blindfolded. Based on what they see and touch, they describe the elephant as being a rope or a wall or whatever, right? I actually don't even see the real distinction between quant and fundamental, and it's not as if quant people are completely blind to fundamentals. When they're doing quant, they're looking at a lot of fundamental information, right? They're not just doing technicals or technical data analysis, right? So I actually find all this classification very artificial and amusing in some sense.
No, but when say Nandik operates and does only index investing, I'm sure his strategies are overall quant. He only looks at the price movement of a particular index and manages money. And he is also giving a good great returns and consistently for time. So that's a differentiation when I'm talking about. Probably if you would be managing, so AI also looks at fundamental parameters like what is the return on equity, the price earning multiples and other parameters.
Ajay, Nandik can perhaps comment better on what he does in his quant strategies. I'm telling you my interpretation of what quant is, right? So when I do quantitative techniques, I don't restrict myself to price or volume information. I actually look at a lot of fundamental data, right? And when I say fundamental, that means everything that any fundamental guy would look at, balance sheets and P&L and everything, right? Of course, the touchy-feely part of what so-called fundamental managers like to do, which is read between the lines and predict some trajectory or quality of management or corporate governance, that's harder to model in numbers, right? Other than that, every number that a fundamental guy would look at, quants can look at too. That's my definition of quant. Okay, maybe Nandik can throw very quickly in a minute light on what he does in quant, since this is an interesting discussion perhaps for everyone. Yeah. And I can then talk about the AI/ML part of it. Nandik, you want to talk?
No, so it's so the way I approach it is it's a function of what kind of a mandate the fund has. So, for example, if it's an equity plus kind of a fund, let's say 70-80% is kind of equity linked, and the remaining 20-30% is more, let's say, derivatives based, then because the objective is to generate alpha over Nifty, I can do, or let's say I can hold on to the positions for longer, because the market is down 2 or 3%. If I'm down 1%, I'm happy. But in the absolute return fund, in which let's say the mandate is to give debt plus kind of returns, sometimes I'm forced to act or react to prices, because if I don't react to prices, and let's say given day the P&L loss becomes 20 or 30 bits, there is no guarantee that in the next 1 hour that loss won't become 30 or 40 bits. So the stop losses, which let's say I employ in a more debt plus kind of a fund, are more price based, because I can't afford to be too much down in a single day. And the standard deviation and the risk measures go for a loss. Whereas in the equity plus kind of a fund, because the leeway is much longer, it's a longer game which you are playing, then the kind of quant which you are implying, that takes over.
Perfect. So Nandik, really guys, I am so feeling so much interested to continue this discussion for another hour, and we will separately do that. But because the paucity of the time, I think we'll have to wrap up this discussion in next 2 minutes or so. I wanted to very quickly understand, Raman, from you. So as you are using AI, what do you think are the limitations of AI in managing the portfolios? This is one very important thing to have to understand.
Yeah, Ajay, 2 minutes is obviously going to be very little for this, but very quickly. It's sort of probably important to understand what AI really is, because a lot of people think of AI in very different terms, and media has certainly not helped, right? I think in its simplest terms, think of AI as techniques that helps a computer do what it is easy for you as a human being to do, but very hard for computers to do traditionally. Anything which is procedural, anything which can be described as a series of steps, if then else, independent of how complicated, how many instructions to be followed, computer is going to beat you any day, right? Where you've been able to beat the computer as a human being is where things are not precisely driven by logic and flow. Okay. That is where, so for example, recognizing a face, right? Even when the face is deformed, you would be able to recognize the face. You can't describe how you are able to do that. If someone's eyes are changed or nose is changed, you can still recognize them, right? But can you describe what's going on in your brain or in your mind in a sequence of steps to say, how did you recognize that face, right? That's a problem that traditionally computers couldn't solve because you couldn't program to it. You couldn't give them a set of instructions, howsoever complex. AI, put simply, is allowing computers to do stuff which you do easily, but they never did. Okay. Now, how you apply AI to different problems can yield completely different results. Okay. So therefore, I would not restrict application of AI ML to only one type of fund management, right? For example, the way we've been using AI ML at Altacura with good returns, as you know, is essentially generating signals on an underlying. That underlying could be any index, it could be a stock. The idea is if using various data, it is able to see patterns and predict with better accuracy than a normal analyst of what direction an underlying is likely to take, right? And let's say it is accurate even 75% of the times, a lot of money can be made, right? Once you know that a stock or an index is likely to move up, move down, or remain range bound, there are very well understood option-based strategies you can use to make money. You don't need innovation in those strategies, right? The same standard, the strangles and the straddles and the butterflies and the condors would do the trick if you knew which one to be applied when. I think that when is what those signals help me answer. And that's what the team then uses, right? So AI ML can solve many problems. We solve a very specific problem with our fund. I'm sure as more and more AI ML progresses, there will be many fund managers doing very many different things.
No, both can now. I think we should end this discussion by saying that the humans and AI will coexist as in other sectors in fund management industry also. So AI can become a co-fund manager going forward. So guys, as I got another reminder from Aishwarya, our host, that we should stop our discussion here. We will definitely continue it offline. I'm really engrossed in this talk that much. Thank you very much. Thanks everyone.
Thank you.
Thank you, everyone.
Yes, Aishwarya, over to you. Thank you very much.
Thank you very much, Mr. Vaswani. In fact, I have to say that you led the session in such a way that it made it very, very intriguing. And I'm sure the viewers wanted to know more, learn more from our esteemed panelists who shared such compelling and pertinent points on the theme. So I'd like to thank them very much as well, Mr. Harsh Agarwal, Mr. Nandik Malik, and Mr. Raman Nagpal. Thank you so much. And thank you to our very able moderator, Mr. Ajay Vaswani. Thank you, sir.